This undictated podcast is brought to you by Futuregrowth Asset Management. Hi, this is Candice Paine. I'm sitting with Wikus Furstenberg. He's a fixed interest portfolio manager with Futuregrowth Asset Management. And today we're just going to talk a little bit around the outlook for the South African bond market, where we've come from, where we're going, and some of the risks that we're looking at going forward into 2015.
Yes, Candice. I think looking back, and if I look back, I want to think about the last 12 months, say to the end of March of this year, actually had a good year for bonds. I mean, globally, as we know, yields surprised most. If you go back to the beginning of 2014, a lot of analysts and so-called commentators thought that US bond yields are only going to go up because the Fed is probably going to start hiking policy tighten policy at some point. And in a similar vein, on the local side, there were concerns earlier in terms of sustained currency depreciation, the impact of that on future inflation. January, of course, was one of the big months for us, where the index did very, very well. We gave back about 50% of that performance in the consecutive 2 months. But still, if you look at the total picture, bonds did really well. I mean, it outperformed cash handsomely. It did much better than inflation. And even nominal bonds did better than inflation-linked bonds, over the last few months. You didn't want to hold inflation-linked bonds from the end of May of last year until around about the end of February of this year, simply because inflation surprised on the downside, and partly because of much lower oil prices.
Vickers, let's just talk about that real return that you can get from bonds, which is obviously what an investor is after. They're wanting to outperform inflation. And what we've seen is that you've actually had superior real returns from bonds over the last couple of years. Why is that, and what can investors expect going forward, given that the inflation expectation is probably lower, and that may mean that interest rates don't rise as quickly as the expectation was?
Over the last few years, and we say last few years, I think we need to go back to 2008. We all know what happened since 2008. The globe battled with sub-trend growth, and the globe also had to face lower inflation, in some cases fear and even evidence of negative inflation. As a result, you've seen bond yields going much, much lower than many thought possible, not only in developed markets, but also in some of the emerging markets. And there's been a lot of capital appreciation that came through on the back of that. So in a way, one's got to be really, really careful to be too focused on historical returns. It's done very well, but planet Earth had to battle with these things that we've mentioned. And I think going forward, in my mind, don't expect and don't extrapolate the same sort of real returns we've seen over the last few years. Expect lower returns, expect lower real returns, and expect more volatility, because yields are low. You've seen, even in Europe, some of the bond yields are trading at close to negative levels. Now, that's not sustainable. It's there because of quantitative easing. And at some point, you're going to see some normalization coming through, and you should keep and focus on that.
And what does that normalization mean for the average investor if they need to be managing their expectations down in terms of absolute return that they're going to get going forward? How do they view bonds in terms of a total portfolio or as a standalone investment, if that's where their income has actually been coming from in the past?
I think two things you need to focus on. Total return in this space obviously consists of, as you mentioned, income, and then of course possible capital appreciation. If bond yields fall, the price of that bond will go up and you will gain, and that gives you a total return that, like the last few years, actually surprised on the upside. For an investor who's focused on income, the bond market will always be the place to be, because you will receive your income. That bond will pay a coupon every 6 or every 3 months. It will, unless the issuer, or the borrower in this case, defaults, like African Bank, of course. But usually borrowers in South Africa are really quite good. They tend not to default on their debt, and with 1 or 2 exceptions, it's done very well over time. So clients should really be focused on that, and then don't bang too much on that capital appreciation.
Okay, so some of the risks that the investor faces is obviously interest rate risk and credit risk. There are also a whole bunch of idiosyncratic risks for the South African investor in the South African bond market, and some of the things that would be foremost in people's minds are things like Eskom, the rand, the rating of our debt from an international point of view. Can you touch on some of those also, and how you view that in the context of your portfolios?
I think firstly maybe Eskom. As a standalone entity, we know all the problems. Even my 12-year-old knows about that, so there's not much value I can add to talk too much about Eskom. But from an investment perspective, the bonds that are issued by Eskom carries an explicit government guarantee. So
that's good to know then, from an investor's point of view. It's not another ABLE.
It's not another African bank. So the risk of default obviously sits with central government. So you have a view, if you have a view that central government is going to default, then of course there's a different issue. So that's the way we look at that. Clearly though, it is still, I think, necessary for Eskom bonds to trade at a discount relative to government bonds, because it's just a different issuer. They have their own issues. But I think in terms of default risk, one shouldn't worry too much about that. In fact, I think you can make a case to add exposure to Eskom bonds over time, because it has cheapened. It's cheaper to go out and buy Eskom bonds at this point, and still going to get your income. They're going to pay that coupon every 6 months.
And when you say it's cheaper, it means that there is potential for capital gain when that value unlocks.
Well, that's one thing. That's a possibility. But again, in this environment, we don't focus too much on that. I think the point here is that it is just yields gone up, prices gone down, we get more for our bucks, and I think that's the focus. And then in terms of credit ratings, with all due respect, credit rating agencies tend to be backward looking. I think a lot of the bad news in terms of South Africa as a sovereign, in terms of Eskom and some of the other state-owned enterprises like Sunroll, for instance, is in the price. And they just, I think, confirming by decreasing the credit rating like they did over the last little while. Going forward, we're comfortable that South Africa's sovereign credit rating will not be downgraded soon. I think for now we're doing enough to avoid South Africa's credit rating to go to sub-investment, and that's how we position our funds at the moment as well. A number of reasons for that. I think the most important one, and it's not the only one, but the most important one, is the fact that National Treasury is really working hard on sort of trying to reduce the budget deficit. Good news of late was the fact that tax revenue actually surprised on the upside, and that was because of even better compliance, and that's good. I mean, the reason for that improvement is good news.
Okay, and just before we wrap up, can we just talk a little bit around the influence that foreign investment flows have on our bond market? Because obviously foreigners are after the yield that South Africa can give them, but what does that mean in terms of the volatility? You spoke about volatility and volatility going forward. What does that mean for your bond portfolios?
I think firstly, we need to have a feel for the size of the exposure in the local market. According to National Treasury, it's close to 40% of total local currency debt. That's big.
That's big.
Yeah. So obviously that's linked to South Africa's inclusion in foreign currency indices, Citigroup and a few others that we can mention. So a lot of that is passive management as well, but there is active management. So if something happens that makes them uncomfortable A 40% holding will make a difference. If they start selling, then bond yields will have to respond. It will go up. There's no doubt about that. As simple as that. So it adds to the risk of volatility. At the same time, though, it's good to have more participants in the market because it improves liquidity. And you always want sort of people on both sides, buyers and sellers, to improve price discovery. So there's a downside to it, but there are obvious benefits to foreign participation in the local market as well. I think it's also important to mention that their participation is different to what it used to be a few years ago. It was very opportunistic a few years ago, in, out. It caused sometimes silly moves. It didn't really add any value. I think the majority of those investors now are probably more sort of medium long-term investors, and that adds some stability to their presence.
Okay, and that's also good news that they're taking a long-term view on South African debt.
True, but it can also change quickly.
Of course.
And that's the problem.
Wikus, thanks so much for your fascinating insights into the South African bond market. I've been speaking to Wikus Furstenberg, who is a portfolio manager with Futuregrowth Asset Management. This Undictated podcast is brought to you by Futuregrowth Asset Management.